You know that feeling. Drowning in data. Just trying to find the really important nuggets.
It's information overload, definitely.
Exactly. Well, today, we're cutting through all that noise for you.
We're doing a deep dive.
Yep, a deep dive into Anand Rathi Wealth Ltd, specifically their latest results.
That's right. They're Q1 for fiscal year 2026. So that's April to June 2025.
Our mission here is, well, to get past the headlines, we want to pull up the critical stuff, maybe some surprising facts.
We've gone through their press release, the financials, the investor presentation. Basically, we've done the homework.
So you don't have to. The aim is to help you quickly get what's going on with their performance, what's behind it.
And importantly, what it might mean for wealth management in India generally.
Okay, so India's market is booming. Lots happening. How does a firm like Anand Rathi not just, keep up, but actually thrive?
Well, let's start with the big picture. The headline numbers for Q1.
Right. Let's look at the consolidated figures first. Profit after tax, PAT.
Came in at 94 crores. That's up 28% compared to the same quarter last year. Pretty strong.
28%. Wow. That's significant growth. Is that just because they're getting bigger, or is there more to it?
That's the interesting part. Their assets under management, their AUM, also grew significantly.
How much?
Reached 87,797 crores. That's up 27% year on year, almost perfectly in line with the profit growth.
Okay, so profit and assets growing almost hand in hand, 28% and 27%.
Exactly. And that suggests, it's not just scale for scale's sake. It looks like a really efficient model where growing assets translates very effectively to the bottom line.
That makes sense. Good efficiency there. And it wasn't just PPT and AUM, right? What about revenue?
Total revenue was up, too, by 16% year on year, reached 284 crores.
Okay, solid growth, maybe not quite as dramatic as PT, and profit before tax, PBT.
PBT showed that same 28% year on year growth, hitting 126 crores.
So the pre-tax profit mirrors the after-tax profit growth.
Interesting.
Yeah. And earnings per share, EPS, also jumped, up 29% to 11.3 per share. And we should mention that EPS figure is adjusted, isn't it?
That's right. They did a one-for-one bonus share issue back in March 2025. So they've adjusted the historical EPS to make the comparison accurate, apples to apples.
Good. So overall, really strong headline numbers. Sets a positive picture.
Definitely. And now we can kind of dig into what's actually driving these numbers.
Let's do that. Operationally, what stood out? It sounds like they had a really good quarter for bringing in new money and clients.
A blockbuster quarter, you could say. They reported their highest ever quarterly net inflows.
Highest ever. How much?
A massive 3,825 crores flowing in during just those 3 months.
Wow. Okay. And clients, are they adding new families?
They are. Active client families grew to 12,330. That's up 19% year on year.
And how many new families in just Q1?
598 new client families joined in the quarter. So strong growth there, too.
How do they support that kind of growth?
Yeah.
These people on the ground, right?
Absolutely. And they've been expanding their team of relationship managers, the RMs.
The advisors who actually work with the client?
Exactly. They now have 382 RMs. That's an increase of 22 over the last year. You need those people to manage the growth and maintain service levels.
Makes sense. So RMs are key. What about where the money's actually coming from, the revenue streams?
A big chunk comes from mutual fund distribution. That revenue stream hit 113 crores in Q1.
And how does that compare year on year?
Up 27%. So growing strongly in line with the overall AUM and peak growth.
And within their AUM, what's the mix like? Still heavy on equities.
Yes, equity mutual funds are still the largest slice. They make up 54% of the total AUM as of June 2025. Seems pretty consistent.
And are people investing lump sums, or is it more systematic?
Well, here's something interesting. Their monthly SIP inflows, systematic investment plans.
Yeah, the regular monthly investment.
Those have really picked up. They rose to 75 crores per month in Q1 this year.
From what level before?
It was 50 crores per month in Q1 last year, so a significant jump.
That's great for the SIRM, right? Predictable inflows.
Absolutely. Predictable revenue, builds AUM steadily, and shows clients are committed to long-term investing. It's a win-win.
Okay, so the core wealth business looks solid. What about other parts of the group? Subsidiaries, digital initiatives?
Yeah, the subsidiaries are contributing too. Their total revenue was up 18% year on year, about 10.5 crores.
Okay, and the digital side. So something about digital wealth, DW.
Right. Their digital wealth platform saw its AUM grow 19% year on year. It's now at 2,055 crores.
And who uses that platform? Is it for the big H&I clients?
No, this is interesting. It's targeted specifically at what they call the mass affluent.
Define mass affluent.
Individuals with existing financial assets somewhere between, say, 10 lakhs and 5 crores.
Ah, okay. So using tech to reach a broader segment below the traditional H&I focus.
Yeah.
Smart.
It seems like it. They have over 6,200 clients on that platform now.
And they also have that platform for other advisors, right? OFA.
Yes, the Omni Financial Advisor platform. That's for external mutual fund distributors, MFDs, and independent financial advisors, IFAs.
How's that doing?
Growing well. The number of advisors using it is up to 6,627 now. It was just over 6,000 last year.
And those advisors manage a lot of assets through the platform.
A huge amount. The platform assets under management are nearly 1,058,000 crores.
Wow. Serving how many end clients?
About 23 lakh clients are managed through that OFA platform by those advisors. It's a massive ecosystem.
So they're building tools not just for themselves, but for the whole industry almost.
It looks that way. It strengthens their position in the market significantly.
Okay, let's shift gears a bit. We've seen the strong numbers, the operational drivers, but what's the secret sauce? What makes clients stick around?
Well, they talk a lot about their client-centric, uncomplicated approach.
Buzzwords, maybe? Or is there substance?
I think there's substance. Look at their client attrition rate, measured by AUM lost from departing clients.
Yeah? What is it?
It's incredibly low, just 0.11%.
0.11%.
Yeah.
That's almost nothing.
Exactly. It suggests clients are genuinely happy and trust the firm. That's real stickiness.
Any other data points on that stickiness?
Yeah, they mentioned that 79% of their clients have been with them for more than 3 years.
Okay, so long-term relationships.
And those long-term clients account for 60% of their total AUM. So the core of their business is built on these established relationships.
And within that client base, they seem to be focusing more on the higher end, the HNIs.
Definitely. There's a clear strategic shift happening there. If you look at the AUM breakdown,
Go on.
the share of AUM coming from clients with 50 crores or more has jumped significantly.
Wow.
It was 12.3% back in June 2020. Now, as of June 2025, it's 26.9%, more than doubled.
Wow. And the segment just below that, say 5 to 50 crores.
That's also grown from 46.2% to 52.7% over the same period.
So a clear, successful push towards wealthier clients.
Exactly. Higher value clients often mean more complex needs, potentially higher margins, and certainly larger AUM per client.
Which probably ties into their specific investment strategy. It seems quite distinct.
It is. Their core recommended portfolio is a mix, 65% equity mutual funds and 35% structured products.
Okay, 6535 EMF and SPS. And what are they aiming for with that mix, performance-wise?
They're targeting an IRR, internal rate of return, of 14% to 15%.
That's quite ambitious. What about risk?
They manage risk carefully. They aim for a beta of 0.6 relative to the market.
Okay, explain beta 0.6 for us again.
It basically means the portfolio is expected to be less volatile than the overall market. If the market moves up or down 10%, this portfolio would ideally move only about 6% in the same direction. Lower swings.
Yes, bumpy ride.
Ah.
Got it. And they mentioned alpha too, Jensen's alpha.
Yes, aiming for a Jensen's alpha of 4% to 5%.
And alpha is?
It's the excess return you get above what you'd expect for the level of risk taken, compared to a benchmark. Essentially, it's a measure of skill or strategy effectiveness. A positive alpha is what everyone wants.
So they're aiming for strong returns, but with lower than market volatility, and hoping their strategy adds extra value on top.
Precisely, that's the goal.
And have they actually achieved this? Historically.
Well, their presentation shows some impressive long-term numbers for this strategy. From April 2014 to June 2025.
Okay, over a decade.
Right. A 10 crore investment in their model portfolio would have grown to 56.15 crores.
56 crores from 10. What's the TGR on that?
That works out to a 16.57% compound annual growth rate.
How does that compare to just investing in the Nifty 50?
Over the same period, 10 crores in the Nifty 50 would have grown to about 37.97 crores.
Okay, significantly less.
Yeah, the Nifty's TGR was 12.58%.
So their strategy significantly outperformed the benchmark. Did they hit their alpha and beta targets?
Actually, they exceeded them based on this data. The portfolio achieved a Jensen's alpha of 6.72%.
Higher than the 4-5% target.
Right. And the beta was 0.55, slightly lower risk than the 0.6 target.
So better returns, lower risk than expected. No wonder clients stick around.
It aligns perfectly with what clients seem to want. They mentioned a survey they did.
Oh yeah. What did it define?
Surveyed almost 5,000 investors. 92% said they prioritize risk-adjusted returns.
It makes perfect sense. People want good returns, but they don't want to lose sleep over volatility.
Exactly. And this strategy seems designed to deliver just that.
You mentioned earlier something about assets under influence. What's that about?
Ah, yes, AUI. That's around 1,070,000 crores. This isn't money they manage directly in their main AUM.
So what is it?
It's other assets their clients hold elsewhere, maybe real estate, direct equity, insurance policies, old investments they've lost track of.
And Anand Rathi does something with this.
They offer what they call product audits on these assets, like a lost folio audit to find old shares or funds, a real estate audit, an insurance audit.
To help clients optimize their entire financial life, not just the money managed by the firm.
Exactly. It builds incredible trust and positions them as the primary advisor, even for assets they don't manage directly. And maybe eventually some of that AUI converts to AUM.
Very holistic approach. Okay, let's talk shareholder value. Client performance is great, but how's the company itself doing for its owners?
Very well, it seems. Their annualized return on equity, ROE, is running at 44.4%.
44% ROE, that's really high.
It is. Shows strong profitability relative to shareholder equity. And their PT growth, as we discussed, is not just strong, but consistent.
You mentioned market agnostic.
Yes, they highlight that over the last 13 quarters, their average year-on-year PT growth has been 33.1%.
Okay.
And the standard deviation of that growth is only 4.4%, which means the growth rate itself is remarkably stable quarter after quarter, regardless of market ups and downs.
That consistency is valuable. Predictable earnings.
Very much so. And they've been rewarding shareholders directly, too.
How so? Dividends.
Yes, regular dividends. For FY25, the total dividend was €14 per share before that bonus issue.
Okay. Anything else?
They also did a share buyback recently worth about 164.65 crores.
Returning cash to shareholders that way, too.
And of course, that 1.1 bonus issue in March 2025 we talked about. It increases the number of shares, making them potentially more accessible.
So, consistent profit growth, high ROE, and direct returns to shareholders through dividends, buybacks, and bonus issues. Looks like a shareholder-friendly company.
The track record certainly suggests that.
Okay, let's zoom out now. Look at the bigger picture. What's happening in the market and the economy that helps or hinders them?
Well, Q1 FY26, the period we're looking at, saw a pretty strong rebound in the equity markets.
Right, after maybe some volatility early.
Exactly. The Nifty index climbed 8.5% in the quarter, and the broader Nifty 500 was up even more, 10.7%.
What drove that?
Seems like renewed buying interest from domestic investors played a big role. So a positive market backdrop definitely helps a wealth manager.
And the overall Indian economy, what's the outlook?
Still looking robust. GDP growth for this fiscal year, FY26, is projected around 6.6%.
Driven by.
Strong domestic demand, continued government spending on infrastructure, and a healthy financial sector. Pretty positive tailwinds.
And that economic growth presumably creates more potential clients for firms like Anand Rathi.
Absolutely. More growth means more wealth creation, which increases the pool of HNIs and ultra HNIs.
Is there data on that HNI growth?
Yes. The number of taxpayers earning over 1 crore annually grew by nearly 18% between FY18 and FY24.
Wow, almost 18% growth in top earners.
And projections suggest the HNI population in India could grow at a CAGR of almost 16% between 2022 and 2027.
So the target market for wealth management is expanding rapidly.
Significantly. It's a huge opportunity.
I mean, you mentioned mutual funds earlier. Is there still room for growth there in India?
Oh, absolutely massive room. Look at this comparison. India's equity mutual fund penetration, if you measure equity AUM as a percentage of GDP.
Yeah, what is it?
It's only 4.7%.
Okay, how does that compare globally?
The global average is 32.4%.
32% versus less than 5. Huge gap.
Huge. It shows just how much potential there is for growth in professionally managed assets like mutual funds as India matures financially.
Are we seeing signs of people shifting towards that?
Definitely. There's a clear trend in household savings. People are moving away, slowly, from traditional assets like bank deposit.
Like fixed deposit.
Right. Bank deposits were almost 54% of household financial savings back in 2013-14. By 2023-24, that dropped to 42%.
Where's the money going instead?
A noticeable chunk is going into mutual funds. Their share increased from just 1.3% to 7.0% over that same decade.
Still small, but growing fast relatively.
Exactly, and it highlights a critical issue.
Which is,
The typical Indian household asset allocation, heavily skewed towards those traditional lower return assets, currently yields only about 7% per year.
which is barely keeping up with inflation.
Precisely. Real returns are negligible, maybe even negative sometimes. Your money isn't really growing in purchasing power.
Which creates a massive need for better financial advice and wealth management.
Absolutely. It underscores why firms offering sophisticated risk-adjusted investment solutions are so crucial for Indians looking to build long-term wealth.
So huge market potential. How is Anand Rathi positioned geographically to capture this?
They have a solid footprint already. Offices in 18 cities across India.
And internationally.
They have a representative office in Dubai already, and they mentioned strategic plans to open new offices in London and Bahrain.
Interesting. Expanding their international reach, too.
Seems like it. Targeting NRIs and potentially other international clients.
So looking at everything, Q1 was strong. How does it stack up against their own goals for the full year, FY26?
That's a great check. Based on their Q1 performance,
Yeah.
they've already achieved 24% of their full-year revenue guidance.
Okay, right on track, one quarter in.
And 25% of their full-year PT guidance. Again, perfectly on track.
And AUM, that grew a lot.
This is the impressive one. They've already hit 88% of their full-year AUM guidance after just the first quarter.
88%. Wow, so they're way ahead on attracting assets.
It suggests very strong momentum carrying into the year and high confidence in meeting, maybe even exceeding, their targets.
Okay, so wrapping this up, it feels like the main takeaway from this deep dive is, well, these aren't just good numbers for Anand Rathi Wealth in Q1.
No, they're really a reflection of a strategy that seems to be working very well.
Right. Leveraging that client-centric approach, the specific investment strategy, focusing on risk-adjusted returns.
Tapping into the digital space, focusing on HNIs, all within this context of a rapidly growing Indian wealth market.
It all seems to be clicking together.
It does. The consistency, the low attrition, the performance metrics, they all point towards a well-oiled machine executing effectively.
So a final thought for our listeners to maybe chew on.
Well, think about India's growth path and how households are just starting to shift towards financial assets like mutual funds.
Yeah, that low penetration rate compared to global averages.
Exactly. How might this big shift towards professional wealth management, driven by the need for better inflation-beating returns, actually change things?
Change things for individuals or the market.
Both, really. How could it redefine personal financial futures in India over the next, say, 10 years? And what does it mean for market dynamics?
And maybe thinking about your own goals. Given these trends and insights, does it make you reconsider any of your own financial strategies?
Something to ponder, definitely, as India's wealth story continues to unfold.